Hello, everybody. Welcome to the DAT Weekly Market Update. This is our update for September 13, episode 215. I'm Dean Croak, market analyst here at DAT Freight and Analytics. I'm sitting in for Ken Adamo this week, and I'm also joined by Group Product Manager at DAT, Chad Kennedy. He's our resident expert on all things shippers and trucking. Good morning, Chad. How's it going?
Hi, good morning. It's going great. Thanks for having me on, Dean.
Yeah, it's exciting. I'm looking forward to chatting to you about the shipper world and the upcoming RFP season and what demand looks like. But before we dive into the market update, tell us a little bit about yourself and how you got here.
Yeah, thanks. So I started my supply chain career with the trucking company, Gene High Trucking, in about 2005. Spent about 5 years there, and then went over to a shipper, Shep, which I think a lot of carriers know from their blue pallets. So I spent about 10 years at Shep as a shipper, and then came over to DAT on the analytics and product side of the business. So it's about 25% as a carrier, 50% as a shipper, and now 25% on the analytics and product side of the business.
You bring a unique experience to the table. Chip is part of the Brambles organization still, is that correct?
Yep, that's right. Yeah, sure.
Yeah, they were still a famous Australian brand from when I was growing up. They were predominantly a big tanker fleet and heavy haul.
Yeah, that's right.
All right, so let's get into the market update and some of the trends we're watching. We'll bring Chad back in a little bit later to talk about the market once we get through the market update. Let's start with our key trends of the week. Remember, folks, if you're watching and you've got questions, make sure you get them into the chat channel as quick as you can. They tend to build up towards the end. Our main job here is to answer all of your questions, so make sure you get them in. We've got a team of folks answering the questions at the back end, so get those rolling in, and let's get started with the market update. Some of the trends we're watching this week. Spot rates for all three equipment types are within a few pennies per mile of 2018. We'll show you some of that information on the charts. Contract rates, which Chad's going to cover a little bit later, are entering routing guides about 6% lower in dry van, about 4 to 5% lower in reefer, pretty flat in flatbed. Big news this week, of course, is the latest strike action is looming large in other transport modes. Their strike action has been approved by the Security Guard Union on the West Coast. As the separate longshoreman negotiations continue. Security guards is very separate to the current contract with the ILWU, but it's expected that they would honour any picket lines. So we're watching that one with a lot of interest. Of course, the biggest story this week is the 33-month-old negotiation between unions and railroads, set to escalate into possible strike action on Friday. Talk of a national rail shutdown is almost unheard of. I'm sure Congress will get back to work legislation and help the parties determine some of the right outcomes for wages and benefits to end this round of collective bargaining. We're already seeing some of the railroads wind down some of their services. So I think we'll see an impact in the spot market this week as some of that capacity jumps in to move some of that volume that's being shuffled out of the rail network. Imports are still flooding into the country at a near record pace. August volumes were up 4% last month. The shift from west to east continues. East Coast volumes were up 10% last month, as in August, and West Coast volumes were down 2% to magnify the shift that's been going on. And of course, it's National Truck Driver Appreciation Week. Remember, a wave or smile goes a long way. You can join the conversation at #ThankYouTruckers. All right, so let's start our market update with the load-to-truck ratio for dry van. It was a short work week last week, as you all know. It also marked the end of summer vacations and back to school, so volumes were predictably down about 7% to start September. Compared to last year, they're about 33% lower. As has been the case around most public holidays this year, carriers have been taking more time off this week, so no surprise there with a 9% week-over-week decrease in equipment post. Total equipment post volumes, though, are still higher than where they were in 2019 for the start of September, to give you some perspective about how loose capacity is in dry van. As a result of fewer load and equipment post, the dry van load to truck ratio increased slightly to 3.64. In refrigerated, and following the rush by shippers to get freight into position ahead of Labor Day celebrations, load posts cooled off last week, dropped 8%, still about 38% lower than this time last year. And even though there was little change last week, carrier equipment posts are at their highest level in refrigerated in the previous 6 years, even surpassing 2018 levels by about 6%. When you look at the data underlying the load-to-truck ratio, you can see that equipment posts are almost identical to where they were in 2019 when capacity was really loose. Load-to-truck ratio last week decreased slightly, 7.36 to 6.81 at the end of the week. And in flatbed, load post volumes are about 50% lower compared to this time last year, only within 4% of 2018 levels, which of course was a good year for flatbed carriers. Load posts were down 15% last week, down about 12% in the last month. That market continues to cool. On the equipment post side, volumes are very similar to 2019 also, and about 40% higher than this time last year as capacity continues to loosen. Flatbed load to truck ratio remained mostly unchanged last week at 14.28 loads per truck. Having a look at our market condition index, starting off with dry van, and in the northeast, outbound spot rates in the northeast jumped by 13 cents a mile to an average of 192. It was quite amazing. It seemed no one really wanted to take a truck up into New England last weekend, which is understandable given the lack of infrastructure and truck stops. Springfield, Mass, one of the region's major manufacturing centres, was the only market to post higher weekly load post volumes. Springfield to Cleveland, one of the major lanes out of there, 600 miles, loads were paying $1.55. That's up 12 cents a mile over the last 3 months, still 22 cents a mile lower than this time last year. And even though it's a small market, rates did spike in Charleston, West Virginia. Last week, line haul rates increased by 54 cents a mile to an average outbound rate of $2.58. Short haul loads from Charleston to Baltimore, only 362 miles, up 20 cents a mile last week to an average of $4.22. That's the highest since May, and still around 40 cents per mile lower, though, than this time last year. Having a look at the Pacific Northwest, capacity continues to tighten. Rates were up in the entire region by about 3 cents a mile for dry van, averaging $1.32 per mile. Seattle, not so good. Line haul rates were down significantly. Seattle to Ontario, of course, that's the major lane on the I-5. Rates hit the low of 54 cents a mile last week. It's almost half what they were this time last year. It's also about $1.50 per mile lower than when the floods hit the Pacific Northwest last December. So rates are really low southbound Seattle, Ontario. In the opposite direction from Ontario, California to Seattle, rates have also decreased, giving you an idea of how much volume is decreasing on that particular lane in the spot market. At $1.43, they've been down $1.43, since the start of the year, averaging $2.65 for northbound loads last week. And in Los Angeles, line haul rates fell for the third week in a row to $2.11 per mile. Remember, folks, these are line haul rates in the spot market, excluding fuel. Last week in Los Angeles, rates were down 4 cents a mile, and at $1.74 a mile are around $1 a mile lower than this time last year on the Los Angeles to Chicago lane. So capacity is really loose on that long haul lane that competes with intermodal. Having a look at the refrigerated market after dropping for the prior 3 weeks, Los Angeles outbound reefer rates ended last week at about $2.45. One of the busy lanes from Los Angeles is to Las Vegas. It's only 270 miles. A lot of carriers are doing that round trip in a day. Rates increased last week to $4.99 per mile. That's excluding fuel. That's 87 cents a mile lower than this time last year. And about $1.36 per mile lower than last November's $6.35 a mile peak rate. Further north in Stockton, capacity was tight again, 14 cents a mile increase in outbound rates, averaging $2.58. Stockton southbound to Los Angeles, rates increased to $2.81 per mile. That's about 76 cents per mile lower than this time last year, though. And again, having a look at the Pacific Northwest as produce season really starts to ramp up, spot rates increased for the fourth week in a row to an average of $2.09. That's up 25 cents a mile in the last month. Loads 630 miles south to Stockton. Out of Twin Falls, we're paying $2.40. That's almost 35 cents a mile higher than the average of August. And in the cross-border market in Laredo, load post volumes were up last week, even though import produce volumes from Mexico to the US are about the same as where they were last year. Capacity was pretty tight. Reefer line haul rates were up 9 cents a mile to an average of 2.20. And in Michigan, produce season continues to push higher volumes into the market and drive up spot rates following last week's 24 cents per mile increase to $3.12. That's an increase of 54 cents a mile in just the last 3 weeks. And in flatbed, after decreasing for the 3 weeks prior, Los Angeles outbound flatbed rates were up 6 cents a mile last week to an average of $2.36. Loads to Las Vegas were paying much higher at $3.37. That's almost 50 cents a mile lower, though, than this time last year. And in the southeast, like the northeast in dry van, flatbed capacity was scarce last week. Rates were up 30 cents a mile in the southeast region to an average of $2.94. In one of the largest flatbed markets in the country. In Atlanta, rates increased to $2.71 last week for outbound loads. Savannah rates are up 36 cents a mile to $2.90. Savannah to Memphis, though, rates dropped to their lowest level in 12 months at $2.19. That's almost 70 cents a mile lower than this time last year. And in the big steel market in Gary, Indiana, flatbed rates are up 47 cents per mile last week to an average of $3.19, reversing the downward trend in August. And wrapping up with Houston, average outbound rates dropped for the 4th week in a row in Houston to an average of $2.67 for outbound loads. Lots of movement, though, on the oil sands lane from Houston to Edmonton. Spot rates at $2.40 a mile are about 60 cents a mile higher than this time last year. So wrapping up our market update with our year-over-year view of spot rates, in dry van rates have been down about 32% since the start of the year, down 3 cents per mile last week, ended last week at $1.88 per mile. That's about 60 cents per mile lower than this time last year. And as you can see on the chart, just 4 cents per mile higher than this time in 2018. And to level set, dry van line haul rates are still 24 cents per mile higher than the average of pre-pandemic years at the start of September. In refrigerated, line haul rates are almost identical to 2018 following last week's 5 cents per mile decrease to a national average of $2.19. Reefer spot rates are now 66 cents per mile lower than this time last year. Remember, these exclude fuel. They've dropped by almost $1 per mile or 31% since the start of the year. And similar to dry van, are about 25 cents per mile higher than the pre-pandemic average for the first week of September. And lastly, in flatbed, after dropping by 41 cents a mile since June, flatbed line haul rates were relatively flat last week at $2.24 per mile. Excluding fuel, spot rates are now 44 cents per mile lower than this time last year, and about 1% or 3 cents per mile higher than in 2018, which of course was a great year for flatbed carriers. And that wraps up our market update for this week. Remember, if you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published this evening. With that, it's on to our short-term forecast. So starting off with dry van, we can see lots of model disagreement again. So let's refresh everyone's memory. The blue line is our historical rate as a 7-day weighted moving average, excluding fuel, long haul only, loads more than 250 miles. And then we have our 4 forecast models. Green is our flagship ratecast model. Red is our short-term weighted model. And then we have the 2 blended models in yellow and gray. Which is a sort of a blend of both of those in different degrees. So this is the second week in a row we've seen model disagreement. The end of the cone is widening a little bit, as you can see there. The short-term model is expecting, by the time we get to the end of September and into October, fairly significant model disagreement. The green ratecast model is expecting rates to lift a little bit. We're not talking about big jumps in spot rate levels, but certainly decreasing towards September, which isn't unusual. When you have a look at our historical rates, you will see that rates tend to tail off between now and the start of October, or sort of the end of October and into November ahead of Thanksgiving, when rates start to pick up again. So lots of model disagreement, though, which is the second week in a row we've seen this. We're seeing about a 20 cent per mile difference between the short-term forecast and our green ratecast model. Be interested to see how that goes next week, especially if the intermodal strike goes ahead. And in refrigerated, again, all the colors are exactly the same. They represent the same thing as in dry van. You can start to see a little bit more model disagreement by the time we get into October. We're talking more like 20 to 25 cents range by the time we get to the end of the reefer forecast cone. Again, nothing unusual with the green line there. That's where we think rates are going to end up. And then they'll start to pick up towards Thanksgiving, given all the reefer demand that'll be moving, especially about 3 weeks out. So once we get to sort of the start of November, we should start to see reefer rates pick up. And in flatbed, almost the same level of model disagreement as refrigerated. I tend to think the way flatbed rates are going, that somewhere the yellow line, the blended line, is probably more like where rates are going. But of course, hurricane season is just starting to get going in the Atlantic. We've already seen some activity in the Pacific. That could change things dramatically with some major hurricanes. Let's hope that doesn't happen. Of course, we don't want to encourage any of that. But that's where the short-term forecasts end this week. And with that, it's time to bring Chad in with our IQ question of the week. With bid season underway, or RFP, requests for proposal season, what can we expect to see from shippers this year, Chad?
Yeah, so with all those forecasts that you just showed and the rate trends that you just showed, what a difference a year makes that we've seen over the last year. So shippers are starting to get some benefit on rate side in their contract rates. That's starting to come through over the last few months. So as we talk to shippers, what we hear is typically staying on planned bid cycles. The one area that we do see some shift is where shippers are starting to focus a little bit more on mini bids and to think about spot more strategically and take those lanes that don't fit into a long-term rate bid and keep those into spot. A lot of that has to do with internal communications with senior management. A typical procurement department is going to want everything to be bid out in a major RFP, but I think that you're seeing more and more shippers starting to pull those out of the RFPs and keep them in the spot market and use that strategically. A good reference point of that is the recent Freightvine podcast. A great interview of Steve Judge from Newell tells that exact story, and we're hearing that more and more.
Chad, why would a procurement department want to bid out every single lane, even though some of those lanes are what Professor Kaplis calls ghost lanes, where no freight appears, or even like a lot of lanes where there's only one load a year?
Yeah, it kind of comes down to traditional procurement practice, and transportation is very unique. So if you're a procurement manager over things like lumber and steel or paper, other raw goods that you're procuring, you're going to want everything should be in a proper bid. And so spot market does go to a proper bid typically. It's just a different method of bidding it out, and it's a little bit more last minute. But a general practice of procurement department would be to bid things out in advance. And so there's just a lot of helpful communication that can occur between that transportation manager that reports up to a procurement manager. And we see about a 50-50 split of transportation managers that do report to a procurement officer. A lot of times nowadays, you'll see them reporting up to a vice president of logistics or supply chain.
I mean, I was with a shipper last week talking about the RFP season. One of the things occurred to me when they showed the acceptance ratio of all of the truckload carriers. It's of course one of the main criteria that I guess they judged them on in terms of their performance was how many loads they were accepting through the EDI tender process. But if you have all of your lanes in a routing guide, don't you almost set yourself up for failure as a shipper if you've only got one load every 3 months on a lane?
Yes.
And you're kind of hoping that the contract carrier has a truck at the right place at the right time for you?
Yes, if you're defining failure as that metric, yes, you are. I think some shippers may look at it as an opportunity when the market does soften to take advantage of some of those bid rates. We often talk about those as like paper rates, because we know that when a carrier is bidding on a load that only occurs once every 3 months, it's not necessarily a commitment to be there when that tender comes through.
Right.
But as the market softens, they will get bites on those. They will accept in the routing guide. In a market like this, you're probably getting a better cost and maybe even better service if you're letting it go to a spot market type scenario. And I think that's kind of the strategic shift that we're seeing with some shippers. We're
Right.
seeing an increase in spot utilization overall. Since 2015, we've measured this. So if I look back at the peak of the carrier market when rates were very high in 2018, shippers were putting about 17% of their freight into a spot type scenario. And then in this most recent tight cycle in 2021, that went up to 20%. It was actually a 3.5 point difference. So a significant shift there. Arguably, this 2021 cycle was a bit rougher on shippers than the 2018 one. It seems to be the case that each type market gets worse and worse for shippers. That's the trend that we've seen from an inflation standpoint.
Yeah. Traditionally, we've always thought about the spot to contract ratio as like a 90-10 ratio, but the 80-20, even there were some weeks where I thought it was more like 75-25 in 2021, which of course was more of an outlier. Do you think we'll revert back to more normal times and stick around 90-10 between spot and contract?
I think it'll move in that direction. I'm not sure where we'll land. I'm expecting it to probably stay a little bit high. I think shippers are starting to think about it slightly different. I think you will see some shippers out there, right? There's always exceptions. You'll see some shippers that'll, certainly take advantage of the spot market where they can. Maybe shorten their routing guide instead of going 3-4 deep. Maybe they just go 2 deep and then straight to the spot market after that. And so you'll see some differences in how they play that out by shipper.
So talk us through how that happens. How do they shorten their routing guide? Is that, do they do that through software like programming, or is it manual intervention?
Yes, through the transportation management software. So they'll publish their rates into that software. And, the typical oversimplifying is in order of lowest cost. It can be more complicated that based on volume commitments from the carriers as well. And then so the first tender goes to the tier 1 carrier and then tier 2 and so on. Typically, when we talk to shippers, they'll have that about 3 or 4 deep. They'll expect 90% acceptance, depending on the consistency, the smoothness of demand on that lane. Right. A good 90-95% on a very consistent lane from that tier 1 carrier, and then they'll expect that tier 2 carrier to pick up some overflow as volume changes from week to week. And then it'll go down to tier 3 and then maybe to the spot market that's typically built into that transportation management software. So they can change that. They can shorten it from 4 to 2 if they want. And that's typically done in a bid cycle. So when they're making awards, they would make that type of change.
Is there a big difference between dry van, refrigerated, and flatbed when it comes to the mix?
We're not picking up on a big difference. There is more of the mix that we pay attention to is intermodal and truckload over the road. We've not seen a significant shift there. This next week's going to be very interesting, how that plays out. I think this could be a pretty significant event if the strike does go through. You and I were talking earlier. I mean, this could be like a snowpocalypse type of event from a demand pressure standpoint, especially on dry van. And especially that long haul dry van. So it'll be very interesting to see how that plays out and what that does to that mix.
And that kind of leads to one of the big questions we've been getting from a lot of our listeners is, and we alluded to this at our broker symposium last year, and that is, it appears as though shippers are working more with brokers over time, or is that just an anomaly? How do you see that relationship working?
Yeah, we do see that playing out in our data. This is something else that we measure back to 2015. So from a percent of shipments, if I go back to 2015, we were around 17% of shipments with brokers. And right now we're sitting, well, in 2022, when we measured this around May, it was around 24%. So it's gone up, several percentage points. This is right in line with what we see on the spot mix. The typical shipper may have $100 million of annual spend. They may have 100 asset-based contracted carriers. And then they may have 10 brokers that they utilize for flex capacity. Now, there's always exceptions to those rules. You've got some asset-based players that are playing in the spot market for them, and you've got some brokers that are hauling some long-term reoccurring contract rates for them as well. But we do see a more acceptance of those brokers coming in and moving more of that freight for them.
Okay.
I think even over the years, you've seen some brokers a little bit more active in the drop trailer solutions, which most of your shippers, that's where that asset base, that 80% of their volume is typically going with those asset-based carriers on regular route freight with high turn ratios, and there's drop on both ends. And then they try to gain some flexibility with those live movements.
Right. So let's fast forward to the RFP season that's currently underway. On one side, I see truckload carriers talking a pretty aggressive game with the need to keep rates where they are at increased rates given the increase in operating costs, most notably fuel. On the other hand, our data is showing that rebidding is going on. Carriers are anecdotally coming to shippers and saying, "Can I offer you a lower rate to secure more volume?" So how do you see this playing out this year? I mean, our data is showing that rates are decreasing. Certainly, the new ones entering routing guides.
Yeah, I believe we will see rates decrease, specifically in the contract area. I mean, we've already seen it significantly in the spot area, and that's typically the leading indicator to what we will see in contract. So we've seen spot converge with contract, meaning spot going lower than contract rates since April, May. And so 4 months of that's a long time. That will continue to put pressure on contract rates. So it's an alternative in the marketplace that's going to pull those rates down. And as shippers are holding competitive bids, I mean, trucking transportation is a great competitive market. And so carriers will be forced to compete on rate and service. One of the most important things to our shippers is service. When we poll them time after time again, services is number one. So I do suspect that we will see continued decreases in rates. When you look at it from a shipper's perspective, 2021 was the worst year they've ever had. They took 23% inflation in 2021. When we compare, and that's contract and spot all together, right? So that's that 20% mix of spot and 80% mix of contract. When we look back at 2018, which prior to that was the worst it had ever been, it was 12%. So almost twice as bad as it was in 2018. I think we had several hurricanes leading into that season that really kind of tipped the scales there. And then COVID pushed us into this one a little bit. So I do think that they're going to get some of that back. And I think that shippers do recognize that costs are up for carriers as well. Fuel's up. Fuel surcharge program should protect a large portion of that. And so, I think you will see these bids produce what they're designed to produce, which is a competitive marketplace.
Right. One of the things that struck me, and this is a question I want to ask you, and that is the person that's doing the procurement aware of how much time carriers are spending on their loading docks? And because to carriers, it's a huge cost. There's, a truck's got to be running $1,400, $1,500 a day in terms of revenue. And of course this is anecdotal, but there's a certain warehouse in California where live loads are 8 hours. They post that at the dispatch office, 8 hours one load. Hamburger mince in Colorado, 18 hours. Frozen French fries in Maine, 24 hours. These are really, you might say, well, they're outliers. Well, no, they're not. It's when capacity loosens and demand tapers off, shippers tend to hold carriers longer on their docks. And I just wonder, does the cost of that particular component end up in the, as a focus for the procurement manager as they think about rates?
Yeah, I think so. I think, from my experience as a shipper, some of the larger asset-based carriers are more and more in tune to this, especially with their drop trailers, and are working with shippers on giving them the intel, especially when you have a scenario where transportation is procured centralized. So you may have a scenario where a shipper has 100 plants across the country and it's procured out of one central location, and getting that data to that shipper in the procurement department is really critical. Communication's key. Can be a little more challenging with the smaller carriers, but having that data to back up those wait times is really critical and give them that information. The shippers know that they are paying for that, whether it be directly through accessorials for wait time or it be just higher cost because of the reputation of a dock. They're paying for that. That's one of the things that we try to help them flesh out a little bit with our benchmark rates. So we can give them a benchmark rate on a lane that tells them here's what your peers are paying on this lane. And if you're over or above, let's try to learn why. And if you're above, is it that you're not paying accessorials for wait time? Is that you just have egregious wait time? So helping them work through those root causes to try to drive that down. And the nice thing about that is they've got real dollars and cents that they can show to the local plant. Here's the money that we can save if we can reduce wait time. I think it's going to take a massive collaborative effort. It is one of the largest opportunities within transportation as a whole, I think.
That kind of leads into our last question before we wrap, and that is that if I'm a carrier trying to get into a shipper's network, what sort of things would you recommend? Any tips?
Yeah, that's a good question. We recently talked to several of our shippers about this. Some of the approaches that we hear them taking are that they will let a carrier into their network in the spot first. So let them participate on those spot activity. So if you're a small carrier, if you've got 10, 20, 50 trucks, and your sweet spot is, let's say, South Florida, you want to partner up with a shipper that has continuous freight out of there with some volatility that you can help them on some of that spot. It's hard to prove yourself out in a spot scenario because what they're looking for is good service. And by nature of it being spot freight, it's usually that last minute, that short lead time freight that a few other carriers may have already rejected the tenders, and now you're kind of left holding the bag and you're expected to deliver on time. Really difficult to perform on, but if you can prove yourself in that market for them, and remember, you should be compared to everyone else in that spot market, right? So then they will start to make some awards in the contract and their bids and get you on some reoccurring freight lanes. The ability to drop trailers is huge. If you have that opportunity to drop trailers and even partnering with them to maybe get some trailers on lease, on rental, to put them in place. If you've got a long-term reoccurring lane, that'll be a great help to them as well.
Fascinating. Chad, thank you. This has been a wonderful conversation. I've actually learned a few new things this week. I thought I knew a lot about shippers, but turns out I didn't. Thank you for being on the show.
My pleasure. Thanks, Dean.
And with that, we'll talk about some of the things we've got coming up. You can watch a recording of last night's show with Jory Myers from Atlanta Dispatch. I was on last night talking about National Truck Driver Awareness Week. You can go to transportationandlogistics.club. Tomorrow I'll be on Sales Chatter with Dan Deegan and DJ Flores, 9 a.m. Eastern. Connect with them on LinkedIn. Also on Landline Now tomorrow evening at 7 p.m. Eastern on Road Dog Radio Channel 146. Don't forget DATCon. Our user conference is on October 5 to 7. The legendary Terry Bradshaw NFL quarterback is going to be there speaking. Early bird pricing is still available. Use the code LATEBIRD2022. And this week there'll be a really good seminar on operating costs. Todd Amon at ATBS has got a webinar this Thursday at 3 p.m. Eastern. 3 p.m. Pacific, 6 p.m. Eastern. Go to atbs.com. Don't forget, next week is CSCMP's EDGE conference. You can meet Chad, Chris Kaplis, and Inam Ayub. They're from our shipper team. They'll be in Nashville last week, where you'll hear about what they're doing to help solve the current supply chain challenges. And with that, it's the time to wrap up the show. Remember, it's Truck Driver Appreciation Week. A wave goes a long way. You can join the conversation at #ThankYouTruckers. And with that, we'll say goodbye, thank you, and travel safe.